Think big. Think positive. Never show any sign of weakness. Always go for the throat. Buy low, sell high. Fear, that's the other guy's problem. Nothing you have ever experienced can prepare you for the unbridled carnage you're about to witness. Right. Super Bowl, the World Series, they don't know what pressure is. In this building, it's either kill or be killed. You make no friends in the pits and you take no prisoners. 1 minute, you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
Hello and welcome to the Grain and Oilseeds podcast. I'm your host, Craig Turner. I am a broker here at StoneX, focused on the grain and oilseed markets. And this is our new StoneX studio. So if you are seeing us on YouTube, we're going to have these on video now. And if it's audio on podcast, thanks for listening. If you have any questions for me, you can always call me at 312-706-7610. You can also follow me on Twitter, which is at Corn Wheat Soy. And if you want to check out the latest webinar series or sign up for our quarterly webinars, just go to www.grainsandoilseeds.com. That's plural, grainsandoilseeds.com. And you'll get on our monthly, our quarterly webinar. The next one is going to be the day after the presidential election. And not only are we going to go about, South American weather rallies, but also, depending on who wins, what our outlook's going to be, and the kind of strategies and what to expect going forward. So that's very exciting. Go to grainsandoilseeds.com. And if you haven't already signed up, once you sign up for the quarterly webinar, you'll get notified, you're part of the series. But if you haven't, go ahead and go there. So all right, we're going to talk a little macro markets first, and then we're going to get on over to the grains and oilseeds. I'm taking a look at a chart of the S&P right now. And listen, the S&P, we're at about 5,500. 5,700 was pretty much the high watermark here. A 10% correction brings us down to like 52. 20% correction would be all the way down to like 4,500. I think that's kind of unrealistic because that would also be the bear market, but we certainly can sell off, and you can make a case here. We've double topped. Usually what happens when you get back from Labor Day weekend, you tend to see selling in the market. Why that usually is, and I can tell you this from my days working on Wall Street when I was right out of college. I worked at a big investment bank, and it was basically skeleton staff the last 2 weeks of August. Anyone took the 2 weeks off, went out to the Hamptons, and they didn't come back till Labor Day. And out in the East Coast, they don't start school until after Labor Day. So it was kind of like the last hurrah of summer over there. Anyways, fund managers used to come back in, take control of the reins on that Tuesday after Labor Day, and start selling everything. So that was usually par for the course in my experience. And I graduated college in 99. So I was in New York on Wall Street from late 99 until 2007. That was just generally what you kind of expected with a lot of these, with the stock market here. We'll see what happens. We are weaker again today. I wouldn't be surprised if we're weaker for the rest of the week. There's going to be a lot of questions about the election, what that means for the economy. But I think we're pretty much in a holding pattern here. As far as, interest rate cuts in the U.S. dollar, I still think we're around, we're fairly consistent. And with the recent pullback in the dollar, will help for exports. And we are heading into the export season for the United States for corn, soybeans. I'm hoping to see more wheat exports too. So let's get into that then. We'll get into corn first. Going to bring up a corn chart here for all of you who are watching the video. Let's go to December corn. Closed today at about 410 3/4. We're recording this after the close on September 5th, Thursday. And listen, I have been bearish on corn for a long time now. And I'm starting to get bullish. I really am. I think there's more bullish potential than bearish. I think that, listen, if the 20% inflation is real, and I really think it is, from anything from transportation, car, gas, food, going to the grocery store, buying new clothes for kids as they go to school. I mean, real estate, whatever it may be, it seems like prices are pretty much 20% higher since 2019, since COVID, right? So, the old $4 corn is really 330. All right. The old $3 corn is now 360, kind of thinking. When I see corn at a 2 billion carryout, through 2015 through 2019, a 2 billion carryout and a 14% stocks usage usually meant harvest lows 325, 330, 335, somewhere around there. And so that's 390, 395, $4, 385. You can make a case maybe corn went down a little bit farther than it deserved to be, especially in September. So we had a lot of pricing had to be done at the end of August because all those DP contracts and basis contracts, anything that hadn't been priced but had a cash contract attached to it at the elevator, it just made a lot of sense for a lot of farmers to price it instead of roll it or go over to a new crop month. So created some pretty heavy pressure on the corn market for the end of August here. We're seeing the pop up now, and here we are at 410. $4 feels right to me for corn right now as a harvest low. To me, that's like a 330, 335 low. We got a 2 billion carryout. And honestly, when I start thinking about acres next year, I see more of a chance of carryout getting tighter in 2025. And, if, next time doing the podcast, I got to bring up my spreadsheets here and show that on the video too. Still trying to get the StoneX media room all set up. But when I take a look at 90, let's say trend line yield, and we're at around 90 million acres, which is what we are this year, we pretty much, we start to either stay the same or draw down on stocks year over year. And I can't remember the lot, it's been 3 or 4 years since we've been able to say that. If we're at 80 in years where we've been well below cost of production, when, for anyone who's, basically is renting land for producing corn and soybeans, like we are now, we sometimes see 88, 89 million acres. So let's say we're at 88 or 89, and we are anywhere around high 170s for the yield. When I do my plug and chug for next year, we are at a 1.5 billion carryout. To me, that means price is over $5. Now let's talk about that for a second. The old trading range was 330 to 425. I know I've been saying this. You add on 20%, we're like a 4 to 530 range, right? So I'm thinking, fours is going to be kind of these harvest lows or right around there. And if we get South American weather issues, if we have lower corn acres next year, if we have weather problems, pick up in demand, anything to lose 500 million bushels, which could be, 2 million acres. It could be, going from a 182 to 178, on the yield, higher demand, whatever it may be. And all of a sudden we're up over $5 again. Is it, a guarantee? No. I mean, we could have 91 or 92, 93 million acres again next year and, start off the trend line yield and, we just stay down in the dumps. But, and I know love Arlen. He's fantastic. Chief economist over at StoneX. He was thinking 91 million acres for corn. I would say that'd be my high watermark bearish scenario. I think it's more likely, 90 to 88. And I think it's going to be more on the low range, just because the farther away you get outside of the belt, the less you hear about guys wanting to plant corn or just not going to next year. Soybeans are tougher. So anyways, for corn, I still like straddles. I still like selling straddles the next month or two, even though I'm more bullish on corn now. I still think we're a sideways market for a couple of months. So I don't mind trying to collect some option premium for the next couple of months on these 24. But I tell you what, I think, $4, think about this. So $4 corn, right now in today's prices and if we really believe, if you believe like me, that we have 20% inflation, $4 corn today is the equivalent to 330 corn, back in 2019. So I don't mind doing costless collars if I'm looking at July 25 or Dece 25 and using that $4 mark, which in my mind is close, like the 330 of, 5-10 years ago, and selling that put and then buying something up top to sell into, whether it be a reownership strategy, whether it be, a courage collar for new crop. I talked about my webinar. I'm going to keep on talking about it. I like that. If you want, I think it's a very I think it's a very interesting trade and a very interesting hedge for farmers. We've been talking about the downside for a long time now, and I think we're finally getting some positive upside here. I've been talking about the bear spread and Dece corn. I'm not too sure how long that lasts. Maybe we got another month left in that, but that one is getting tired. So is the Nov soybeans. I thought those spreads would widen out farther, and they haven't. And I think we're seeing the funds start coming out of, reducing their length. I think demand's coming back into the market. The weaker U.S. dollar's helping. And I think the spread market is starting to tell us that, all right, maybe this big bear trend for the past 3 years is now finally coming to an end. And I really do think that's what's going on here in the grain and oilseed markets. Again, the 960 soybeans of today was accounting for inflation is $8 soybeans from 2018 and 19. And even if we're going to have a 550 or 600 million carryout, maybe the lows are the mid nines. I thought we could get down to the low nines. I thought the Nov spread could get to 80, 90 cents. Doesn't look that way. And it seems like it seems like we're kind of bottoming out here. So, probably be anyone who's, we've been doing a lot of hedging on the downside, whether it be for futures or option spreads or future spreads. And I just think now is the time to start coming out of them. I've been out of the wheat market for a while now. I don't think there's a point of having a short in wheat just because we're going to be so tight in the global export market. What I would like to see is some demand come back to the United States, but we've had a nice rally here. I want to say corn is up like 40 cents, 30 cents over the past couple of weeks. We went from basically 385 to 410. All right, so that's 25 cents. We've seen a good 50 to 60 rally in corn and soybean, and I'm sorry, in wheat and soybeans. And from a percentage play, the wheat rally is very impressive that we've had the 60-cent rally. I'm not surprised. I've been saying for a while, the wheat rallies first, especially winter wheat rallies first, and harvest is come and gone, and the major global exporters are very tight. If we see any demand come back to the United States in a meaningful way, I think the funds get long. So the wheat will be, keep an eye on that. If I'm a spec trader, if I'm a farmer who's looking for ownership, or if I'm on the buy side, because, commercials here, I'm using September to load up the boat. And I think there's a lot of ways to do that. Now, how high we go, who knows? But I'm just not so concerned about the low side of after we get through any kind of additional harvest pressure. So something, we could be sideways for a while, and I do think we'll be sideways a little bit. But I would be setting myself up for taking advantage of higher prices in spring, summer, and maybe winter. Maybe this year's winter, but I think it's more likely we're kind of range bound for a while. Let's see here. That is pretty much about it. It's a little bit different this week. We're going to try to, get this up in video. I've got my corn chart up here. We're going to start going over more future spreads and chart analysis. I'm just going to bring up, corn right now. We got a 420 is a pretty good resistance level on corn. For soybeans, soybeans. Support's going to come in at 960. We got we got a very heavy resistance at 1040, most likely, but we have broken through the trend line. In wheat here, I think we're right at the 200-day moving average. We're getting close to it. So chart's looking better. The only thing that's a real problem right now in the grain and oil seed markets is canola. Their most recent news on canola is China has basically retaliated against Canada for imposing tariffs on electric vehicles, and now China's looking to do a canola import ban. And they did something similar to Australia 3 years ago, or in 2000, last from 2000 to 2023, where China banned the imports of barley from Australia into China. And again, it was a retaliation from Australia, basically demanding China be more transparent about the origins of COVID. This time around, it's Canada joining the EU and United States about import and taxes on electric vehicles coming over from China. And China's turned around and is now considering, they're probing Canada's impossible involvement, anti-dumping on canola. I think what also happened here is, China really doesn't need the canola. We've seen their exports way down to begin with. So if they were looking to, to kind of put on, the thing is, like when you put on a tariff on one country, there's usually some kind of response, and this may be their response here, which really just shows you that they don't need canola. When the ban got lifted for Australian barley, surprise, surprise, China needed barley, so the ban gets lifted. So, we'll see when we'll see what happens with Canada and canola. But I think the problem here is, if you take a look at chart November canola, we're down like in this 570, 580 range. Lows were 560. I mean, we were at per ton, and we were at about 620 per ton. Had a nice little comeback here in the canola market, up about $60 per ton by the lows, and then really came back all the way down after that news is released. So what's interesting here is when I take a look at domestic stocks and stock to use, and also major exporter stock to use, what I'm seeing is corn can get a little bit tighter next year. I'm seeing soybeans expanding, but it's banking on a huge Brazilian crop, and we are seeing weather issues. So honestly, maybe looking at collars that, these weather issues and stays, dry in Brazil, and Brazil, I want to say, exports twice as much beans than the United States does. So they are the major player now. Brazil is the major player in soybeans. So if they have weather issues, they could send soybeans to $13, $14. If they have a huge crop like the 169 million metric tons they're talking about, unfortunately, we'll be in the nines for a while. But that's an interesting play too. I think canola could get helped out by a big rally in soybeans, but this, just for those you don't know, Canada produces about 20 million metric tons of soybeans per year, give or take. And it used to be half of it was used for crush and half it was exported, with China, I believe, being more than 50% of the demand on the demand side. Between domestic use and some of the trade agreements that Canada has made when, in Asia, there's more opportunity to crush in Canada and then send the products over, or the oil to Asia and the meal down to California or to the dairy farms down there. So you're seeing a crush now maybe of 12 or 13 million, but that still leaves about 7 million metric tons of canola that needs to be exported. And if China has a ban, it's going to be tough. It's going to be tough to get to 5 million metric tons. And I'll talk to some of our canola guys here, and maybe we can get a little bit better handle on it. But it's tough. Like when you get think about the tariffs when the United States had the tariff war with China. It took a while for even like the most in-depth and knowledgeable experts in the industry to really get a handle on what that meant for prices over the long term, or during or right after it happened. I think that's the same with canola. I think we're going to bottom out here, but it's going to be kind of tough to figure out where we're going and what this demand looks like if we get a Chinese ban. So, little concerned about canola. I think as far as ranking the grain and oilseed markets, I think wheat and corn have some pretty. I like their chances of going higher. Soybeans, you really need a big weather issue, but if you get a big weather issue, soybeans can move faster than the other markets. And canola here is in trouble. One other thing I do want to talk about livestock real quick. So I think we're turning into a bear market on the livestock market. If you take a look at the charts, we're breaking down, just like we did back in like that 14-15 period. We've had high prices for a couple of years. One thing about this thing with Canada, if China's not gonna be buying canola, I think there'd be a good deal of canola acres going It could go into other crops, spring wheat or some of the specialty crops up there in Western Canada. It could also go into livestock, cattle particularly. And Alberta is by far the largest, cattle producer in Western Canada as a province goes. So I wouldn't be surprised if we saw more cattle coming out of Canada next year. Regardless, the packers have control again over the market. They seem to be being able to bid down live cattle and get their prices here. Corn is fairly stable. So when it comes to the crush, if when the packers get control of the cattle market, and if corn is fairly stable with limited downside, when it comes to that cattle crush equation, it's only one place for feeder cattle to go, and that is usually lower. So we can have, now listen, over the short term, you can get rallies and stuff like that. But again, if the packers have control of the market, or at least they're, if they're winning more often than losing, right, and they're able to, have lower bids and get that cattle at lower prices and move the cash price down, because there's too much, because either there's not enough demand or there's too much supply or mix of both. It's probably more likely lower demand. I definitely doubt it's too high supply. But with corn prices where they are holding steady, that means feeders likely are lower too. So I would be looking at, I'm going to be looking to sell in the rallies when they come. I don't know if that's, selling call spreads and buying put spreads. That's worked for us in the past. Or some other strategy. But I do think, and also going out to 2025, I think cattle could be substantially lower this time next year. So we'll be talking more about that. All right. So that is going to be the podcast for the day. I'm going to just, before we leave here, I'm going to bring up a chart of November cattle here. And you can see us, we were up as high as, if I take a look at a 20-year chart of cattle, feeder cattle got as high as 240. Basically, in 2009, we were at 80, 90, 100 in feeder cattle. Went all the way up to 240 after the drought, right? And we didn't have feed and had to cull the herd. We went from 240 down to 120. Basically, lost 50% of the value. That should happen again. Let's say we're at 260. Half the value would be 130, but I really do think you got at 20% inflation on that. So if the lows were, let's say 120 times 1.2, 144, 150. Yeah, I can see us going from 260 to 150 over the long term. And we're at least 180. So that's what I'm going to be targeting and looking for and building trades around for 2025. If you have any questions for me, you want to, go over in these things for your account or your operation, just let me know. If you're a client, you can call me, email me. You can also text me. You should have my cell phone number. And if all my contact information is in all the show notes too. Appreciate everyone listening. And we're going to be looking to do more of these videos going forward to go along with the podcast. All right. Thanks very much.
This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels Trading broker who provides research, market commentary, and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Trading, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors, such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure accessed at www.danielstrading.com. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services.